Welcome to the weekly update, where I'll go over the action in the market for the week of April 14th through the 17th, and we'll see how things look for the week of April 21st through the 25th. Had another down week. We were closed on Friday because of Good Friday, and we are seeing some stabilization though. Prices are more or less in a range right now on the daily side, and we're turning more negative. The market does seem to be vulnerable, but we're holding up above long-term major support, and that's encouraging. Now we're going to be watching that support if we continue to go down to see is there going to be a retest of that, or if we end up falling below it and closing below it, that's going to turn things quite a bit more negative. In the meantime, we're looking at a more negative picture with growth underperforming value, which is what we've been seeing pretty much for 2025. And that's not an offensive market, that's a defensive market. And so things are really starting, or they're continuing, I should say, to shift in a more defensive pattern. Because if you're a money manager and you have ETFs or mutual funds, or if you manage other people's money, and you have an agreement with them either through a prospectus if you're a mutual fund, if you're a mandate, or if you manage an ETF that says we can only do this, well, they can't necessarily get out of the stock market. They have to be invested at all times. And so all they can do is shift their money from one part of the market to another. And that's what we see continuing to happen. And that's when we say the market is becoming more defensive. And a lot of the things that we saw at the end of 2021, and then right after that, we hit the high in early 2022, and then we spent most of 2022 going down. We're seeing a similar situation, but at the same time, there are some positive things that are happening. The situation is rather fluid right now because of the tariffs and it's really coming down to between the US and China, but there's a lot of other countries involved. There's all these pop news items that are coming out that do they really have anything to do with what's going on? There's a lot of behind the scenes work and things that we think might be coming together as far as the markets. We can see that there could be some things going on, and I'll try to point those out as I go through the video, but we won't really know that for 6 months, a year, maybe even a couple years down the road. What was happening right now, will we really get an explanation? And a lot of people have opinions, but I look at the charts. I look at the data that we have. I don't forecast. I don't try to project where we're going to be. It's just a day in and day out. And in the case of this video, week in, week out, evaluation of where we are right now. And then what's the probability? Are we going to go up? Are we going to go down? Are we going to go sideways? So that's my whole approach. And that's why my videos are longer. That's why I don't get as many views on my videos. I don't tell people what to do. I don't just magically come to a conclusion in 3 or 4 minutes. I use critical thinking when I do this for myself, and I try to teach that in the program that I have, how to think for yourself. Okay, just a few notes. There are daily videos that I post, and they're available right when the market closes. Now, I'm coming up with a program that will be starting soon where you can have immediate access to those daily videos if you find that they're valuable. You'll also get immediate access to all the weekly videos. There are 4 weekly videos that I post as well. Now I hold those back. For example, as I'm recording this, about 18 hours ago, this particular video, because this is a second version of this video, but what I'm going to cover in this video was already available to members in the program. And if you want to have access to the videos right when they're available, you would have already watched this video. It would have already been available to you. The same thing is true with the daily videos, where I provide more commentary and analysis. I also am still in the rough draft stages of doing a newsletter. I do one every day. It's called the Daily Pivot. And then I have the 4 weekly videos that I do. Well, there are also newsletters that go with each one of those videos that I'm now combining into one weekly newsletter. That's available, and that'll be a standalone thing that is available in the near future. I do have a PDF that I post with every video that I upload on YouTube and Rumble that's available. And I do have a program. Here's a link. It's also at the top of the description below this video and every video that I upload. This takes you to SPX Investing. I'm hosting on Substack, and it's free for the time being. That's probably not going to last too much longer. But for right now, I just kind of have things wide open. You can come in there, you get immediate access to the daily and weekly videos. You get access to additional videos that I post there. I do some trade ideas, and there's other things that I'm going to be rolling out once I actually lock down the website. Okay, then also every day I update on the YouTube community tab because I can't do this on Rumble. Pivot points, and these are pretty critical. There are two charts. One are pivot points that are only good for that day, and they follow intraday support and resistance. And you'd be surprised how accurate these are. And we know this before that day even happens. That's what makes them so neat. Then there's another chart where I update it every day, but those pivot points last for the whole month. So feel free to check those out. They're on the YouTube community tab. I have a private Facebook group you're welcome to join. Not a lot of members, not really active. If you want to change that, go for it. And I'm pretty much on Facebook all the time. I'm launched in a number of different programs at any given time. So if you have a question, if you have some feedback, you are more than welcome to offer that up. And that also feeds into the next one with YouTube and Rumble comments. I've been having to delete most of the Rumble comments because they're coming from these scam social media folks who they say they're experts. Who knew the world was full of so many social media experts? What they did is they went to some webinar and they say, okay, get people to buy into this software that may or may not even exist or may or may not even work. And that's all they're trying to do. And I just delete those comments. But if you have a legitimate feedback, even if you disagree with some conclusion that I'm reaching or how I explain something, feel free to leave a comment. That is what the comment section is for. If it's a crap comment, if it's a spam comment, if it's one of these social media comments, those get deleted. But legitimate ones from legitimate people, those are allowed and encouraged. Also, I do post on both YouTube and Rumble. So if you can't find me on one platform, look for me on the other one. Okay, let's go back and talk about for the week. Even though we only traded for 4 days out of the 5, we were still down 1.5% on the week for the S&P, but we were below average with volume. And what's interesting is Thursday we were below volume. That ended up being options expiration. That usually happens on Friday, unless it's Good Friday and the market's closed. But you have a lot of confused folks right now. They're not really sure what to do, and we're seeing volume starting to really drop off as they're figuring out, okay, are we going up or are we going down from here? We are turning more negative when we look at the technical picture. Inflation seems to be okay for right now. And the latest reports that we had was CPI, PPI, that's looking all right. And the employment situation seems to be holding up okay. And then interest rates are stabilizing a bit. A week ago, interest rates were just really skyrocketing. And there was all this speculation as to why. Was that China dumping the $1 trillion of US bonds, or at least part of that, on the market because that pushes price down and interest rates up? When these tariffs go into effect, we should be seeing the opposite happen. The dollar should go up. It's been going down. And interest rates should be able to stabilize, in fact, sometimes go lower. We were going lower as the bond market was seen as a flight to safety. People were freaking out in the stock market. They were taking money out of the stock market, getting into the bond market. That pushes prices up and interest rates down. A week ago, we were seeing just the opposite of that, as there might have been some kind of manipulation going on, but we won't know that for quite some time. I've tried to find some information on that, and there's all kinds of theories, but there's very little fact to go on. And we may not ever really find out what was causing all that. But at least things are calming down in the interest rate arena. Now they could pick back up at any time, and who knows what news is going to come out to either encourage the markets or freak out the markets in the upcoming week. And that goes under here with the geopolitical concerns, which also there's a war between Russia and Ukraine, kind of going on. Earnings season, we're just getting started. We're about 12% of the S&P 500 companies have now reported, and there's a lot more still to come. And then there's the debate going back and forth. Are we not going to go into a recession? I don't forecast this. I look at charts, and right now the charts are holding up. But we'll keep an eye on that. There are some warning signs. There are things that are causing us some concerns. There's some things that's causing concern in the markets too that I'll show you and that I do go over on a regular basis. And incidentally, periodically I do a recession video that I don't post on YouTube or Rumble that I do put on the website. Go join the website and you'll have access to that video. And then Fed speak, you kind of got a confused Fed right now. They don't really know how all this tariff stuff is going to play out. You got this war going on between Trump and Powell and all this stuff going back and forth. So that's just most of it's political theater, but still the markets can react to these things. As far as our trend, we are still negative. It's a strengthening trend, it's a confirmed trend, and it's a negative trend. And I'll show you that chart. Okay, so just some bullet points to go through some of the things. We did end lower for the week, and it was turbulent. There was some choppiness going on, but we were below average with volume. We were looking stronger earlier in the week when there was some exemptions from these tariffs that were announced on smartphones, laptops, semiconductors, solar cells, and other electric items. And then the 125% tariff rate is going to continue or be in place with imports from China. Then enthusiasm was limited to this. They didn't get too excited because it still means that there's a 20% fentanyl related tariff that's being put on goods. Then other tariff related headlines that came out throughout the week is that there's this thing called Section 232. It just means they're doing some investigations. And once they get done with this, there might be more tariffs put on these different areas, specifically tech, semiconductors, and pharmaceutical things. And Bloomberg came out and said, the talks between the EU and the US really haven't made much progress in those talks. And so those existing tariffs are going to still be there. And also Bloomberg came out and said that China has ordered airlines to stop taking deliveries from Boeing. That's kind of a big deal. Boeing's the major aircraft, commercial aircraft producer. They've had a lot of trouble over the last year or two with windows flying off and wheels coming off and all kinds of things. But I'm from the Seattle area, so this kind of hits closer to home. All right, and then President Trump also suggested that there may be tariff adjustments in the auto sector. Is that good? Is that bad? And then in corporate news, NVIDIA came out. Now, this is not a tariff. They're sending these chips, high quality, very expensive chips, over to China. Well, they may not be able to do that now. That's more of a trade restriction, not so much a tariff. And that could cost them $5.5 billion with that happening. And AMD, another chip maker, they also came out and said, well, that might hit us for about 800 million, not billion, 800 million. And then United Healthcare, that came out on Thursday. They came out with their earnings report, and they're the biggest component of the Dow. Well, I guess NVIDIA is probably in there now. They're one of the bigger components of the Dow. And their earnings report was not well received. The stock got hammered, and that ended up taking the Dow lower because there's only 30 stocks in the Dow. You get one stock that's really up or really down, and it doesn't matter what the other 29 are doing at any particular time. Okay, and I can't update this because this chart doesn't update. It's based on 5 days, and we only had 4 trading days. So this chart is from the previous week. This is what the market is concerned about. We're still in this period where the dark blue line is still coming down. We're still, for the most part, we're seeing CPI, PPI, it's still coming down. And then what the market's concerned about, though, is after we get done going down, are we going to shoot back up again? And we don't know right now what's really going to happen. Anyone who says they do really doesn't know. I mean, we just have to watch the data. The market doesn't seem all that concerned. about inflation and interest rates. And if you watch the intermarket analysis video, the what to watch video, other videos that I post, I go through that showing that it may be in the media and a lot of people may be talking about it, but the markets aren't necessarily concerned about inflation and interest rates going back up. But something like that could change. Things can change very quickly, and we could find ourselves in the super high inflation environment. This is CPI, and this is what we saw in the mid to late 70s with stagflation, where we saw massively high inflation with pretty much no economic growth during that time before it finally started coming down in the early 80s. So we don't know if it's going to play out this way. It could play out completely different, but it's been kind of matching what's been happening. And I've been showing this chart for, my goodness, 2 years now, as we're just kind of watching this all unfold. Okay, this is another chart that I've shown for quite a while. Every week we say our interest rates, meaning the 10-year yield, are they at 4.02%? Are they above that level or below that level? They're still above it, even though interest rates have come back down from the previous week. This is when they start to bite into corporate profits. And that's why we're seeing earnings revisions coming in that are revising things down for the most part. Then a company, quite often, this is part of the game here, they'll come in and they'll lower their expectations. And then when the earnings do come out, they beat their expectations and then everybody's happy. So it's a little bit of a game that goes on there. All right, now this hasn't been updated yet. This won't be updated until the first part of May. These are long-term unemployed folks, which actually is ticking down for the most part here in the latest reading. Then I couldn't go to Isabel Net. Things were kind of messed up there. So I'm just gonna have to skip through that. FactSet, which is where we get our earnings information from, they had a couple of blog posts. Now this is a bit out of date. This was April 14th. This was almost a week ago when they said, will S&P 500 companies withdraw? That means, that earnings projection that we gave, we need to take that back. We're not going to end up putting that out right now because we think it's going to be quite a bit different. Now, that could be different good or different bad. That's usually taken as something bad. But these are the companies so far that have provided some kind of guidance, and two of those companies have so far said, we need that back. Not really sure who those companies are, but we'll find out sooner or later. Then these are the companies issuing guidance for the first quarter here, where this is above prior guidances for. It's about equal. That's the yellow area. And this is actually below where one, according to this, they're like, we're doing a new report here. Okay, so then we're just getting started with earnings. 12% of the S&P 500 companies are reported. Of those 12%, 71% of those that have already reported, they're coming in above estimates. See, they lower the estimate, then they come out with their report and it beats expectations, hoping that it will get a bit of a bump in the stock price. Okay, so here is the intraday chart where we were looking okay here from Monday and Tuesday. Not great, but we gapped higher and we were able to close pretty much near the high of the session. We were pretty much sideways in on Tuesday. Then this is when the Nvidia stuff started to come out. We ended up gapping lower, and that was a pretty significant day. In fact, what Tuesday was so boring, I had to come in and put these pivot points on the chart. This software only calculates S1 and S2. If we go below that, then I have a pivot point calculator, which if you want to know how to find that pivot point calculator, leave me a comment or send me an email. It's freely available. So I had to break it out, calculate these numbers myself, and then put the lines on the chart. And then Friday, we held on to gains here. But we still ended up being down on the week with most of the damage being done on Wednesday. So for the week, and these are just the 4 trading days that we just finished, small caps ended up being down the least, where we had the Dow, and most of that came on Thursday because of United Healthcare. That ended up being down the most, and all the indexes, just for the 4 trading days, were down. This is not Friday to Friday. This is just Monday through Thursday of the past week. So this goes back to the beginning of 2025. All of the indexes are negative, with the small caps leading the way to the downside, followed by the NASDAQ. The NYSE has been holding up better. There's a lot of value in that index, and that's been seeing a little more favor these days, but even it's down. but its uptrend is holding on. It's weakening, but it's holding on a little bit better, where all of these other indexes are now in downtrends. On the daily side, we're seeing weakness here on the weekly side. Looking at the sectors, since we finished down, that's how I sort this. We had discretionary, a growth area was down. Tech, a growth area that was down. Communication, a growth area that was down. These are the areas we need to see outperforming. That's when the market goes up. When these areas are down, that's when the market goes down. Or a lot of these other ones like energy, real estate, and staples, these are defensive areas. Toilet paper, toothpaste, that's staples. Real estate, that benefited a little bit there because of interest rates coming back down after they skyrocketed up. And energy quite often is seen as a defensive play as well. It ended up, it had a really bad week the week before. It had a pretty good week in this past week. Then I sort these according to their scooter score. That's on a scale of 0 to 100. The higher the score, the better looking that sector. Staples are the strongest, coming in up over 90 at 91.3. And then we have utilities, financials. We like that the financials are doing good, but they're not doing great, but they're doing good. And then the weakest areas are materials. That can be often more cyclical, depending on what's happening with the economy. And then the tech sector, 6.9. You've got 91.3 for the best sector, 6.9 for tech, the worst sector currently. Then this just looks at the 4 trading days, where the ones that were down were tech and discretionary. All the other sectors, now it was a negative week, and this is calculated a little bit different. I take the S&P out of this calculation. I'm just trying to look at the raw S&P sector score itself. Then going back to the beginning of 2025, discretionary and tech are negative, where all of the other sectors are positive, led by staples, defensive, utilities, defensive, real estate, which can be defensive, and healthcare, which is defensive. But we like that the financials are doing all right. We don't want the banks to fall apart or the whole financial sector to really take a hit. Then we look at the relative rotation graph and we're seeing a lot of improvement. But look at these. XLP, those are staples. That's defensive. XLV, that's healthcare. Defensive. XLU, utilities, which you could make a case that utilities are growth because we need all electricity for these AI and EVs and whatever two-letter acronyms you can come up with. And real estate is showing some strength. Energies a little bit too. Financials are holding up okay. The big growth areas, though, communication, that's XLC. That's weakening. And we're seeing XLK, tech, XLY, that's discretionary. These are the weaker areas right now. When you're having a strong market, you see just the opposite of what we're seeing right here. And this shows it more in a spreadsheet format, the areas that are improving here. Communication is more neutral, where we have tech and discretionary, which are negative, and the ones that are hanging on to being positive, industrials and materials, those are both more cyclical, going with the economy. All right, then we just look at the indexes. Now, the S&P's been holding up okay. A lot better than the S&P 100, which is pretty much growth, and a lot better than the NASDAQ 100, which is pretty much growth. There's a balance of growth and value in the S&P. And that's why it holds up a little bit better when we're going down. But you can see how utilities really coming on here, where you have small caps, mid caps, transports. These are the weaker part of the market. Okay, then looking at here where we have the S&P, the Dow Jones Composite. Now that's the Dow, the transports, and the utilities together. They're not getting much strength from the Dow and the transports. What's holding this up green is this next area, which is utilities, which then we break it out based on itself. Or the S&P 100, that's showing some weakness there. And then the weaker areas are more of the growth areas, including transports, mid caps, and small caps. All right, then sentiment. Now, I don't know what's going on with this. We usually get this every week, but for some reason, I've only been getting it every 2 weeks. But these are the folks that are out there saying, buy this, sell that. Well, when you look at all these newsletters or websites or services that they have, and then they do a survey of all this, we're coming in below 1. And this is a scale of 0 to 5. We get overextended to the upside when we get above 3, and we're negative down here below 1. Now, that could be positive because when we get really low readings like this, that usually means that, okay, We use it as a contrarian indicator, meaning that there's a chance that we bottom. But we've been down in this area. We were below one, then we went a little bit above one. Now we're back down below one. So we've been camping out in this area for a while. Then we look at the fear and greed index, and I show this in every daily video, or at least I go through the numbers. We're still below this 25 level right now. That means we're extreme negative. But if you look at the historical chart, we've been extreme negative going back. We set the high in February. We've been coming down below 25. We peaked out a little bit for a while, but we usually V bounce out of this. We've been just camped down here for quite some time, which is unusual. We usually don't see this. Just everybody's really pessimistic. Active asset managers starting to get extreme negative. They've been holding out in more the neutral area in the middle. Now this could go down further from where it's at, but when we start to get down to these low readings, that's when we use this as a contrarian indicator. The VIX still above 20, so that's negative, but it is coming down. And there's some studies out there, there's some research to suggest that when we're above 50, which we went above 50 here, and then we came down and we're below 30, we actually ended up closing below 30 on Thursday, that that can produce some really good things. And but we don't know. You don't want to use that signal all by itself, but this is possibly something positive that could be developing. But the fact that the VIX is above 20, that's negative in and of itself. And we're looking at how cash is outperforming the tech sector, and that's negative. When this line's going down, that means tech is outperforming, and that's when the markets are usually going up. And the right X bear bull ratio, these folks just freaking out all over the place. When this really spikes, that means they're getting into the bearish mutual funds. And then if we get a really low reading, that means they're in the bullish mutual fund. And we're getting very high readings right now with that. And then this is the 8th week now, 8 weeks. We've had the individual investor survey below this red line here. Usually we bounce up out of this. Now we might go through periods of time where we come down, then we bounce up, then we come down. We've just been camped down here for the most part with these latest readings. So usually we use this as a contrarian indicator when we get an extreme negative reading. But are we going to be down there 9 weeks, 10 weeks? How long are we going to be down here? And the Ulcer Index, which is another fear gauge, that's getting a high reading. We're also seeing that on the daily side. The spread between risky and not as risky bonds, it's improving a little bit, but it's still high here. But it could go a lot higher than where we're at. I mainly use this as a sentiment gauge of how are folks feeling in the bond market. And a week ago, this was really going up as people were freaking out in the bond market. So this has stabilized just a little bit. This is that same thing, but inverted, and it's the middle area of this chart. I have the S&P on top and the VIX inverted down below, where we were really coming down. This means fear is increasing. Well, we've been able to bounce back up here as things have stabilized, at least for right now, but they could go crazy again at any time. And then we see this ratio. This is the VIX to the 3-month average of the VIX. When this is really going up, that means the VIX right now is going up a lot more than the last 3-month average is. And that's more negative when we see the VIX really shooting up like this. But we are seeing this okay right now. This is a 253 period moving average. There are 253 trading days in a year, give or take. And so this is the equity put call ratio. When this is going down, that's positive. When this is going up, that means there's more hedging, and that's more negative. We're not going up, and we could, but we're not right now. We're at least stabilizing here a little bit after we had been declining. And looking at the economy, we're looking okay here. This is the weekly economic index, not seeing anything too crazy here. In fact, overall, this is tending to go up, which is showing a little bit of economic strength. Then this is updated weekly, the Chicago National Financial Conditions. We're below the black line. We get concerned if we go above the black line. Now, we are going up a little bit here, but we still have quite a ways to go to get to the black line. Now, this is where we're seeing, and again, if the people out there that don't like the current administration, they're going to look at this chart and say, there's going to be negative GDP. We're going into a recession. Okay, that's what the Atlanta Fed is now estimating. And then they do a gold adjustment one here too, but that's still negative. I guess maybe that's depends on how you look. Yeah, it's just a little bit negative. But they have a negative forecast for GDP. But here's the kicker. You look, okay, here, I'm sorry. I was trying to set up the next slide and this came up. This is showing the Atlanta Fed forecast. This is the kicker. The New York Fed, they're still positive. Now it's coming down a little bit here, but we're still getting a reading of 2.59. So New York is up, Atlanta is down. Do we split the difference? Is there going to be no growth with GDP? That's kind of what I've been looking at here lately. This has not been updated. It will be updated again when the next employment report comes out. This, I haven't updated the chart, but the chart that I do look at is pretty much right here. This is the smooth U.S. recession probabilities. We're still below the black line. That's when we get nervous. We are in a recession if we go above the red line. We're still stable down here for the time being. This is a quarterly report, which is going down, which as long as it continues to go down, that'll be more inducive of us not going into a recession. Inflation, since we're still just starting out with a new quarter, we're seeing some adjustments to CPI and PCE, both the core PCE and core CPI. All right, now 90.9% chance that when the Fed meets on May 7th, rates are going to be right where they're at right now, 4.25 to 4.5. And folks are getting a little bit more convinced that that's going to be the case. But then when we look out to the June 18th meeting, there's a 60% chance right now, but these change all the time, that rates are going to be 0.25% lower than where they're at right now. Now, why is the Fed going to cut rates? Is it to stimulate the economy just to keep it humming along like last fall? That was what the 50 basis point cut was supposed to be for. Folks are starting to think that the Fed may need to come in and cut rates because the economy is getting ready to go into a recession. That changes the whole context. You have to look at why is the Fed cutting rates. If they're doing it to spruce up the economy, that's considered positive. If they're doing it to save the economy, that's negative. Now, this could change, and there's still quite a ways to go. We still have another meeting coming up before this one even comes around. But we'll be watching this. That's why I update these charts every week and getting a little more convinced here that we're going to be at 4 to 4.25% after the June 18th meeting. This is the Fed balance sheet, which has been decreasing for the most part. We saw a little bit of a blip up. This was when the Silicon Valley Bank, Republic Bank had a little bit of a problem there, but it has been declining here. And that's what the Fed said they were going to do. They're letting all these bonds and all these things that they used to prop up the economy during the COVID lockdowns, they're letting them all fall off the Fed balance sheet as they're maturing. Okay, and this is just a year over year look. We're still headed up for the most part on a year over year basis with the Fed balance sheet. This is not really looking all that crazy right now. The overnight reverse repurchase agreements, this actually came down a little bit. It was starting to go up here, which was giving us a little bit of a concern. But now it's started to come back down. So we're not really seeing anything all that crazy. And this mainly applies to the banks. This is the overnight lending that takes place. All right, then looking at our chart, and we're seeing a very similar thing on the daily side. We're still above the moving average with the advanced decline line based on price. We're actually further below the moving average on the daily side, but we're coming right down and starting to drop below the moving average based on volume. So that's turning this more into a mixed picture where it had been hanging on to being more positive. And we're seeing some internal deterioration in the S&P. And we're not seeing an awful lot of new highs. And the reason I have these little words on here, these are the charts that I use for the weekly newsletter. So if you want to pick that up, you can save the time of watching the video and just read through the newsletter here. But we're seeing a real expansion of the new lows. That's what was driving our 4-week and 10-week moving average down. Well, that really contracted. So that's positive, but we're not seeing a whole lot of green here. We need to see the green really going back up to turn this back and show that it's more positive. The advanced decline ratio, both with the 19-week and 39-week, were above zero, so that's a little bit better there. And then this is our trend, and I use a thing called the ADX to measure the condition of the trend. That's the black line, and then there's all these other crazy lines that go with this. The black line is going up and it's above 20. That means we are in a trending environment. I put the moving average on here to give it a little bit of context. So when we're above the moving average, which we are right now, and we're above 20, that means that we're in a strengthening trending environment. Now, the red line and the green line, that determines if we're positive or negative. The red line, even though it's coming down, is well above the green line. So we are in a strengthening, negative, trending environment. All right, then the Arun, which measures the difference between buyers and sellers, we're seeing red above green up here. That the oscillator down below is below zero. That's negative. Mass index, we've got one, possibly two signals on the daily side. We don't know what's going to happen with those. This is one of those indicators where when the criteria is met, which means it goes above the red dash line, above the blue line, then back down below the red dash line. Whatever's happening before that, the mass index thinks we're going to see a reverse. So we're seeing two of the criteria met now, but we won't really pay attention to this until it comes back down to the red dash line. Then here's a daily chart where on the daily side, we're seeing a death cross here with pretty much all the indexes except the NYSE right now, where the 50 period moving average is now below the 200 period moving average. That's a downtrend. Now, we're not in a bear market because we haven't fallen more than 20% on a closing basis from the all-time high that was set back on February 19th. So we're just in a downtrend right now while we're in a correction. When we're between 10 and 20%, which is where we're at right now, that's called a correction. Okay, then we look at smart money indicator number one, and this is more negative. Now, there's a couple of ways you can look at this because I say positive here. Why? Because we're slightly above the red line, which is the moving average. Now, if you want to get a little more detail with this, you can look at the boom indicator down below. And this is clearly going down as the blue line has been coming down and actually dropping below the red line. And even though it's bounced back up, we're still below the moving average. So on a peer level, this indicator is positive because it's above the red line. If you want to get more detailed, this is negative because we're still below the moving average with the boom indicator. Then our second smart money indicator, the chicken money flow, going down with the green histogram, going down with the red line, that's negative. Then our third smart money indicator, we ticked back up, but we're coming down to this pink area, which is the initial extreme negative reading, but we're still below the moving average here. So this is considered to be negative still. So all, depending on how you look at it, smart money indicator 2 and 3, they're clearly negative. 1, a matter of personal interpretation. Okay, the vortex, this is negative with the red line above the green line. And this is actually positive here. We were coming down. We broke below this pivot point. We came all the way down to S1. We held there for a while. Then we broke down below it, got back above it, and we're still above this S1 level. This is part of the longer term support that I'm showing here. And these pivot points here, and you remember at the beginning of the video, there's some that change every day, some every month. These last for an entire quarter. So they can be really useful for long periods of time here. In fact, looks like some of these last for a whole year here. So this is long-term support that for right now is still holding. This is another long-term support level that continues to hold. The midpoint of this trend channel going back to 2009, we're still above it. And we're looking a little more negative here. The 50-week moving average of the S&P, we're below the red line. And even though we're bouncing back up a little bit, we're still below the red line, which will eventually turn the red line over if we don't see an improvement. Now, this is a moving average crossover. We're still positive here with the 13-week above the 50-week. We're already negative on the daily side. We're seeing vulnerability here on the weekly side. And we're a little bit above zero with the McClellan oscillator. We're actually showing that same thing on the daily chart, just barely positive right now. So we saw a bit of a tick up, but when you look at the summation index, we're below zero based on price and volume. This is improving, and this is actually positive on the daily chart. I don't have the same lines here on the weekly chart, but we're seeing pretty much the same thing. The bullish percent index measures the point and figure buy or sell signals inside of the S&P 500. Well, when we're really coming down, these are sell, 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 sell. We hit an extreme reading, and now we're starting to bounce back up. And I also have some moving averages on the daily chart, and we're above that moving average, and we're going up. So that's actually positive. And we're above zero with the swing trading oscillator based on price and volume. That's positive there. But momentum is clearly negative. We're going down with the PMO. We're below zero based on price and volume. We saw a little bit of an improvement with the PMOs that are rising. The buy signals, after being extreme negative, are improving. So there's some hope here. And we're starting to turn back up with the PMOs that are above zero. These are all the PMOs inside of the S&P 500. So it's each individual, or 503 stocks, and this is taking all of those PMOs together and creating this study. Now, momentum, though, we're negative. We're going down across the board in the short, intermediate, and long term. And this is another momentum oscillator. The Copic curve, it is negative. And then the percent B, this is one implementation of Bollinger Bands. We closed down below the lower band, and we were seeing that on the daily side at the same time. Didn't get much of a bounce, but we got some. And this tends to not last very long. We're no longer extreme negative here. We're inside of the Bollinger Bands again. The force index improved a little bit, but we're still negative. And we're coming down. We're not quite extreme here with the money flow. And we were extreme negative with the Stochk RSI, came back up, but now we're coming back down here. The Williams percent R also ticked down, but is no longer extreme negative. The RSI, based on 14 weeks, we had come down to an extreme negative reading. We were showing some improvement, but we ticked down in the latest reading. Ultimate oscillator also ticking down, but negative since it's below 50. And this is in danger of crossing below the red line, and the red line's starting to go down. This is a long-term oscillator. We are negative on the daily chart, and we've been kind of holding on to the fact that the weekly chart is positive since we're above the red line, but that could change here pretty soon. And we don't get very many signals from this chart. Rate of change, we had a down week, so that's just week over week change there. Longer term, the rate of change does show that even long term, we're seeing some weakness coming into the market. This is both positive and negative at the same time. We were down on the week, so that's why there's a red bar. We're seeing a death cross here with these moving averages. That's negative. But you notice how we came all the way down to this 50% retracement level, and this measures from the October 2022 low to the February 2025 high. We gave up half of that, and we spent a short time there and bounced up off of that, and we've been able to recapture this 38.2% retracement level. That's pretty big. Can we hold on to this? Are we going to come back down and test this again? Now you'll notice something else. This green line, this is the where I define, and a lot of other people do too. If we're above this, there's a secular trend. That's very, very long term. That's the green line. That's a 200 week, not 200 day, but 200 week moving average. You notice in 2022, that's where we ended up setting the low. And I was getting all kinds of comments. People were like, when we were breaking below this, we're going lower, John. Things are looking really bad. Well, the market was able to recover from that and become more positive, and then we ended up coming up out of that. We're still above that level, so that's positive. And the green line's still going up. That's positive too. And it's positive that we've held on to this 50% level and been able to regain this 38.2% level. We'll be watching this longer term. Now, if we go back up, that's of course going to be more positive. If we start coming down, we'll be watching these other areas. And we're kind of a doji look here. That's when you have an open and a close kind of near each other. That's kind of the open candle there with the Heiken Ashi, but after a long series of black candles, which are negative. We're negative here with the Kegi chart since we're red, but we are pointing up. So that's kind of a positive slant on a negative reading. But we're negative with the Renko chart, and we're still negative with the three-line break. So we're seeing a bit of a mixed picture there. And we saw some new X's being drawn in here with the point and figure chart, even though we closed well up off of that. So this is a low pole reversal that was generated over a week ago now. So this is encouraging when we see green X's. When we see red O's, that's bad. That means we're going down. Okay, we're still looking really negative here, extreme negative with the ease of movement going back 14 weeks. This tries to measure the path of least resistance. And yeah, the path of least resistance lately has been down. Momentum, we're really taking a hit here with the long term, leveling out a little bit, the intermediate term, actually improving a little bit with the short term momentum. And we are neutral with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. On the daily side, we've actually switched over to positive. We had enough of an upward thrust to turn that chart back to positive. Okay, and then this is more short term here, where we're negative across the board with all the indexes in the short and intermediate term, with the mid caps negative in the long term, as well as the small caps. And then we're seeing commodities negative in the short and intermediate term, but positive in the long term, and negative across the board with bonds, and negative across the board with the dollar. And this just looks at the indexes with no studies on them. You can see how the S&P has been under pressure, but mid caps have been under more pressure. And what's really not looking good are small caps. Could we see some support? If we keep going down with this, we might be getting back to areas that we were in back in 2023. This held before. Could we get a little bit of a bounce from that, maybe? But we're not there yet. We'll just be watching that. The Dow has now gone into a downtrend on the daily chart, and it's looking vulnerable here on the weekly chart. And I'm going to say that a lot for all these indexes. The same thing is true with the NASDAQ. We're negative on the daily side. NASDAQ 100, negative on the daily side. Mid caps, we're negative on the daily side, and now we're negative here on the weekly side too, as we are with small caps. The Wilshire, this is a daily chart. We saw a recent death cross here. That's broad market, and we're seeing a real hit, but an attempted recovery with all stocks. Those are stocks inside the US and outside of the US. NYSE, you can see the blue line's a little bit further above the red line. It's holding up better, but even it's getting hit. And the FANG index also still hanging on to an uptrend here longer term. We haven't crossed over negative on the daily side, but we are looking vulnerable there as well. ARC is below both moving averages and got hit this past week. The banks, we want them to do good. They're coming up after being extreme negative with the RSI, but the momentum continues to be down. And April is supposed to be a pretty good month, but tell that to 2025. We're up 40% of the time, but if you go over the last 5 years, we show a negative 2.4% return. And this updates every week as well. And then this is just blanket Dow theory, where traditional Dow theory just looks at the Dow and the transports. You can see the transports really not looking very good now. Even the Dow is under pressure. What's holding this together? Now, a traditional Dow theorist may not include this, but I do. Utilities. They just look at the first two indexes, but some folks might include utilities in that mix. This is where we're getting things kind of holding up because utilities have been not doing great, but they've been at least going sideways where the other two indexes are going down. Then we look at commodities, which are still in an uptrend. They came all the way down to their 50-period moving average and so far have bounced. Oil is coming back up into the mid 60s where it had been in the low 60s. We're in a negative trend here with not only on the daily side with the dollar, but here on the weekly side, and we're falling below 100 even more. And copper. Now, this is encouraging because this is one of the barometers that we use for the economy. And I say here, now I'll put this in the newsletter. Copper is often used as an economic barometer looking forward. If the copper market was concerned about economic growth, price would be going down rather than up. We're in an uptrend here. And we were up 3.5% this week. So what's going on with that? I thought the economy is supposed to fall apart. Now, is this infallible? No. But it's done a pretty good job over the years of looking forward, suggesting, okay, this is a look at the economy based on the copper market, and it's holding up for right now. Gold just coming off setting all-time highs, and silver doing okay, but not as good as gold. And then we look at interest rates, where we had come all the way down to the 50-week moving average, and we bounced up off of that. So we're holding up better with bonds based on price. And we're coming down with the stock to bond ratio, the monthly chart. This is showing the bonds are outperforming stocks. This is a daily chart of how the yields were coming down for the most part and then spiked up a week ago and are starting to come back down, even though we went back up in Thursday's session. This is a weekly chart showing US and UK rates at the top, and then German rates here in blue and Japanese rates in red. And I've included commodities here now to get more of a real intermarket analysis chart. We're year to date, gold is doing the best. We have bonds barely positive, commodities are barely positive, and then we go negative here. The dollar, that's green, oil is red, and stocks are black. Then we look at some ratios. This is growth to growth and value. The NASDAQ 100 to the S&P in a downtrend here. That means the S&P is holding up more or the NASDAQ 100 is underperforming. And we're seeing that on the daily side. The S&P 100 still hanging on to a longer term uptrend compared to the rest of the S&P, but showing some weakness. Growth to value. This is really taking a hit. Longer term, it's still in an uptrend. We're starting to see death crosses on various growth to value charts on the daily side. Gold just going to the moon. S&P not doing well. That's why this ratio is really going up. And we're starting to see bonds outperforming stocks. And we're seeing a golden cross here. We're seeing that on the daily side. Watch the intermarket analysis video to see those daily charts. These are all weekly charts here. And this is showing longer term. Bonds are outperforming. And gold is outperforming the dollar because gold's been going up as the dollar has been going down. And low volatility stocks, toilet paper, toothpaste. When the market's getting more defensive, we're seeing it on the daily side. We're seeing it here on the weekly side. This ratio goes up. At the end of 2021, this ratio really started to go up and it went up for most of 2022. That's when we were in a cyclical bear market. Because when I mentioned the secular bear market, that goes on for decades. Where a cyclical bear market, that could last like a year or even a few months, but usually not quite as long. Unless you're a perma bear, then you're always in bearish territory. Discretionary versus staples, hanging on to a very vulnerable uptrend right now. We want this to be going up to be more positive. And then energy is starting to, it came down, but now it's starting to bounce back up when compared to tech. Tech is the big growth area. When this ratio is going down, that means tech's outperforming. When this ratio is going up, that means energy is outperforming. And both small caps and tech have really done terrible. So this ratio is just going sideways now. And then here, secular, that's decades, cyclical, shorter term, maybe months to years there. Just looking at the NYC breadth thrust, just seeing some weakness overall, not really getting much from this chart. We did have a negative reading here with this WAG NYC breadth thrust, but we didn't get up to this red line quickly enough here. So not really getting anything from this chart. We're still above. Actually, we're just a little bit below it. Sorry about that. This is a trend line going back to 1987 crash. And kind of hard to see here. I should look at the next chart. We were right back up to this line a week ago. We fell a little bit below it in the latest reading. Not a huge deal, but still a support level that right now has been lost unless we can get it back. Now, this is surprising here. The Zohorchak method. This is at a full-on buy signal, and this thing's a little more sensitive, at least in the past it was. We'll have to see what's going to happen here because this thing could go from a full-on 10 to like a -8 really quick, but it's still giving us a buy signal, which is kind of a mystery right now. And the NASDAQ 100 weekly chart, we're falling further below the trend line going back to 2009. We're seeing internal weakness with the NYSE, with the new highs, new lows. Even though the NYSE has been holding up better, it's still seeing its own weakness. And then this is the 50-period moving average of the new highs, new lows in the S&P, also below zero and declining, showing internal weakness there. This is still positive. When we look at the NASDAQ 100, which is growth, the Dow, which is supposed to be the best of the best stocks, this is holding up pretty well. If we were more negative, this ratio would be going down. Also, the NASDAQ 100 to the small caps. And even though the NASDAQ 100 has been doing bad, small caps have been doing even worse. And so we're seeing this ratio continuing to go up. And we're pretty much sideways here with the 3-month yield, not really showing any concerns there. And we're still seeing a general tapering off of the cumulative new highs and new lows for the NASDAQ. That's more negative. Seasonality, might as well just throw this out the window. Usually April is one of the better months. We're up 73% of the time, going back to 1964 with a return of 1.6%. And it's going to have to really work hard to get that. And then we're coming up. This is the best time of year from November to April. That's the sweet spot for stocks. My goodness, what's going to happen when we get into May? Well, who knows? We'll have to just see how things go there. And April, first half, second half, they both tend to do okay. And then here's another way you slice up April different ways. It's usually positive no matter how you look at it, but not so far this year. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.